The power of a trading journal is rarely felt at the moment you start writing it, and this is why so many traders abandon the practice before it ever has a chance to work. At first, journaling feels tedious, repetitive, and unnecessary, especially to those who believe progress comes primarily from better analysis or more screen time. Yet trading literature, written by consistently profitable traders, tells a different story. It shows that the journal is not a record of trades, but a record of behavior. And that behavior, not strategy, is what ultimately determines whether progress compounds or collapses. Most traders begin by journaling the wrong things. They record entries, exits, profit and loss, believing the numbers alone will reveal the truth. Numbers matter, but they are the final layer, not the foundation. A trading journal becomes powerful only when it captures the context in which decisions were made. Why was this trade taken? What was the emotional state beforehand? Was the setup clear or marginal? Was there hesitation, urgency, or boredom involved? These details feel subjective, yet over time, they reveal patterns far more actionable than any indicator. Trading is one of the few professions where the same mistake can be repeated endlessly without obvious external correction. The market does not scold. It simply charges a fee. A journal acts as the missing feedback loop. It forces the trader to slow down and translate experience into language. This translation matters. When behavior is written down, it becomes concrete. Rationalizations weaken. Patterns emerge. What once felt like bad luck begins to show itself as recurring behavior under specific conditions. One of the earliest benefits of journaling is the separation of outcome from execution. Many traders judge themselves solely on whether a trade made money. Journals challenge this habit. When a losing trade is executed perfectly, according to plan, writing it down as a successful execution begins to retrain the mind. Conversely, a winning trade taken impulsively loses its shine when documented honestly. Over time, this reframing shifts the trader's identity from outcome chaser to process keeper. And this shift is foundational for consistency. Another overlooked aspect of a trading journal is its role in emotional regulation. Emotions lose power when they are named. Writing, "I felt rushed because I missed the first move," or "I entered early because I was afraid price would leave without me," creates distance between the feeling and the action. Trading psychology literature often highlights this distancing effect as critical. The journal becomes a place where emotion is processed rather than acted out. This alone can dramatically reduce impulsive behavior. Journals also reveal something uncomfortable but necessary. Most mistakes are repetitive. Traders often believe each loss is unique, caused by different market conditions. Journaling exposes how often the same errors appear under similar circumstances, such as fatigue, overconfidence, after wins, or boredom during slow sessions. This repetition is not failure, it is data. Once patterns are visible, they can be managed. Without a journal, they remain invisible and therefore uncontrollable. Tracking progress through a journal also changes how improvement is measured. Instead of asking, "Did I make money this week?" the trader begins asking, "Did I follow my rules more consistently than last week?" This shift lowers emotional volatility and accelerates learning. Trading literature consistently emphasizes that behavioral metrics lead financial metrics. Journals make behavioral progress visible long before equity curves reflect it, providing motivation during periods when results lag behind discipline. Another critical function of journaling is building self-trust. Confidence in trading does not come from winning streaks. It comes from evidence that you can act according to plan even when outcomes are uncertain. A journal provides that evidence. When traders review weeks or months of documented discipline, confidence stabilizes. This stability allows them to size appropriately, wait patiently, and withstand drawdowns without abandoning their process. The most powerful journals evolve over time. Early entries may be chaotic, emotional, and inconsistent. That is normal. As the trader matures, journaling becomes more focused. Fewer words, sharper observations, clearer lessons. The journal begins to reflect the trader's thinking more than the market's movement. At this stage, it becomes less about tracking trades and more about tracking identity, documenting the gradual shift from reactive participant to deliberate operator. And it is precisely here, when the journal stops being a diary of what happened and becomes a mirror of how decisions were made, that its true power begins to reveal itself. The trading journal begins to function less like a tool and more like a quiet mentor, one that never forgets, never flatters, and never reacts emotionally. This is the stage where its value compounds. By returning to past entries, traders begin to see themselves across time rather than in isolated moments. They recognize how certain emotional states reliably precede mistakes, how discipline strengthens after specific routines, and how clarity fades when boundaries are ignored. This longitudinal perspective is impossible to achieve through memory alone, because memory edits to protect ego while the journal preserves reality. As this relationship deepens, journaling starts to influence behavior before trades are even placed. Knowing that a decision will be written down creates a pause. This pause is powerful. It introduces accountability in a profession where no one else is watching. Many traders report that simply maintaining a journal reduces impulsive trades, not because of added rules, but because of increased awareness. The journal becomes a silent observer, encouraging decisions that can be defended in writing rather than rationalized afterward. Over time, traders also learn to structure their journaling to support growth. Instead of free-form notes after each trade, they begin asking consistent questions. Was this trade within my plan? What was my emotional state before, during, and after? Did I respect my risk limits? Would I take this trade again under the same conditions? These questions sharpen focus and reduce noise. They guide attention toward what can be controlled and away from what cannot. Progress becomes intentional rather than accidental. Another evolution occurs when traders review their journals in batches rather than individually. Patterns rarely reveal themselves in single entries. Weekly or monthly reviews uncover themes that daily writing cannot. Perhaps certain setups perform well only at specific times of day. Perhaps losses cluster after long sessions or during periods of external stress. These insights emerge only when the journal is treated as data rather than confession. Trading literature often emphasizes that this review process is where learning truly accelerates. The journal also plays a crucial role during drawdowns. When confidence erodes, the journal becomes an anchor. Reviewing periods of disciplined execution and recovered drawdowns reminds traders that setbacks are survivable. This historical evidence counters the emotional narrative that something is wrong or I've lost my edge. The journal restores perspective when emotion narrows it. It helps traders respond to losses with adjustment rather than panic. As experience grows, the journal becomes simpler. There is less need to describe markets and more focus on internal alignment. Entries become shorter, more precise. The trader knows what to watch for: hesitation, urgency, overconfidence, fatigue. The journal becomes a checklist of mental states rather than a chronicle of trades. This simplicity reflects maturity. The trader no longer needs to document everything, only what matters. Ultimately, the power of a trading journal lies in its ability to transform experience into wisdom. Without it, Days blur together, and lessons repeat without resolution. With it, mistakes become specific, progress becomes visible, and discipline becomes measurable. The journal does not make trading easy, but it makes learning inevitable. It ensures that no loss is completely wasted, and no success is blindly celebrated. And so, tracking your progress through a trading journal is not about proving improvement to yourself or anyone else. It is about building an honest relationship with your own decision-making. It is about creating a space where behavior can be examined without defensiveness and adjusted without drama. Over time, this practice quietly reshapes how you trade, how you think, and how you respond to uncertainty, until one day you realize that the most important thing you have been tracking all along was not the market, but the trader you were becoming through each deliberate, documented choice made under pressure. If this reflection on journaling resonates with you, consider subscribing to continue exploring the deeper habits behind consistent trading, and leave a comment sharing one insight your own journal has already revealed about your behavior.